Have you ever heard the phrase, "You can't fight the Fed"? It's one of the most repeated sayings on Wall Street, and for good reason. The Federal Reserve isn't just another financial institution. It's the most powerful player in the global economy. Whether you're a day trader, a long-term investor, or just watching your 401k, what the Fed does can make or break your portfolio. Today, we're going to break down what this phrase really means, where it came from, and why ignoring it could cost you big in the markets. And stick around to the end, because I'll also share examples when the Fed got it wrong and when the market actually fought back. The phrase, "you can't fight the Fed," means this. The Federal Reserve has enormous influence over financial markets, and betting against its policies is usually a losing game. Why? Because the Federal Reserve controls the cost of money. When it cuts interest rates, borrowing gets cheaper, liquidity floods the system, and investors rush into riskier assets like stocks. On the flip side, when it raises rates, borrowing gets more expensive, money tightens up, and stocks usually take a hit. Think of it like this. The Fed is the tide, and the market is the surfer. No matter how skilled you are, if the tide is going out, it's going to be a rough ride. This saying was popularized by Marty Zweig, a famous investor and market strategist, back in the early 1980s. Zweig noticed that stock prices were highly sensitive to interest rate policy. His advice was simple. Don't overcomplicate things. Don't try to outsmart the Fed. If the Fed is easing, it's bullish. If it's tightening, be cautious. And that wisdom has stood the test of time for over 40 years. The Fed's job is to manage inflation, employment, and overall financial stability. Here's how they do it. Interest rates. Lowering rates makes borrowing cheaper. Raising rates slows the economy. Quantitative easing. This is when the Fed buys bonds to inject money into the system. It boosts liquidity and supports asset prices. Quantitative tightening. The opposite, selling bonds or letting them mature, which drains money from the system. When the Fed steps in, it doesn't just affect Wall Street. It impacts mortgages, credit cards, car loans, and business financing. That ripple effect eventually flows into corporate profits and, yes, stock prices. So when traders say, "Don't fight the Fed," they mean, don't bet against the biggest liquidity provider in the world. Let's look at some real-world cases where this played out. 2008 to 2009 financial crisis. Stocks collapsed, but when the Fed cut rates to near zero and started buying bonds through QE, the market found a bottom and began one of the longest bull runs in history. 2020 pandemic crash. In March 2020, markets tanked. The Fed stepped in aggressively, cutting rates to zero, launching emergency lending programs, and buying trillions in assets. What happened? Stocks rebounded almost instantly and hit all-time highs by the end of the year. 2022 to 2023 inflation fight. The Fed raised rates at the fastest pace in decades to cool inflation. What did the market do? It struggled. Growth stocks fell sharply, housing slowed, and risk appetite dried up. Each time you can see the same pattern. The Fed sets the tone, and the market follows. Now, are there exceptions? Absolutely. Sometimes the market doesn't react the way the Fed wants. For example, in the 1970s, inflation ran wild. Even when the Fed tried to tighten, the market didn't always cooperate. In 2018, the Fed raised rates steadily, but the market pushed back hard with a steep sell-off in December. The pressure was so intense that the Fed actually pivoted and paused its hikes. So yes, the market can challenge the Fed, but notice what happened. Eventually, the Fed adjusted course. Over the long run, the Fed's policies still drive the trend. So what should you take away from this? Pay attention to Fed policy. It's one of the most powerful forces moving markets. Don't fight against liquidity. If the Fed is easing, that's fuel for the bulls. If it's tightening, caution is your friend. Fundamentals matter, yes, but ignoring the Fed is like ignoring gravity. In short, understanding Fed policy isn't optional, it's essential. So the next time you hear the phrase, "You can't fight the Fed," remember, it's not just a catchy saying. It's a market truth backed by decades of history. The Fed is the tide, and no matter how strong a swimmer you are, you don't want to swim against it. If you found this helpful, hit that like button, subscribe for more investing breakdowns, and let me know in the comments. Do you think the Fed is too powerful, or is it just doing its job? Thanks for watching, and I'll see you in the next one.